All right, everybody. So let's get started with the earnings for CVS. Now, if you're watching this now and you saw it yesterday on the live stream, then, I guess you're watching again. Thank you so much for the watch time. But let us get started, guys, with CVS earnings. And let's take a look at starting off with their, if I could find it, with their earnings and, well, with their earnings summary. We can see that they got $2.20, beat by 11 cents. EPS gap actual $1.65. That was a miss by 10 cents. Revenue actual $85.28 billion, which was a beat by $4.61 billion. So let's come now into their actual earnings report and take a look at these earnings, man. This earnings report looks really, really nice. Nice and concise. I love it. So we get over here. Total revenues increased $85.3 billion, up 11% compared to the prior year. Already looking good. GAAP diluted EPS of $1.65, adjusted EPS of $2.20. Generated free cash, I love it. Absolutely love it. Generated cash flow from operations of $7.4 billion. So we got over here the earnings, or we got over here the financial data. 2022, $76.8 billion. To 2023 of 85.3 billion. I love when they also put the increase in numbers, not just a percent. As an increase of $8.45 billion. Operating income went down a little bit, going from 3.5 billion down to 3.4 billion. That's a decrease around $99 million. Let's see. Adjusted earnings per share, adjusted operating income, 4.61 billion down to 4.37 billion. That is a decrease of negative $237 million. Diluted earnings per share, $1.77 to $1.65. That is down 12 cents. And the adjusted EPS of $2.30 down to $2.20. That is down by 10 cents. And let's see what the CEO. Well, actually, here's the guidance. Let's just take a look at the guidance. Revised GAAP diluted EPS guidance range to $6.80 to $7.12 from $7.73. So they revised down. Look at that. Are you seeing this, Mike? So they're actually revising this down from 773 to 793 to now 690 to 712. Revised adjusted EPS guidance range of to $8.50 to $8.70 from $8.70 to $8. So they revised down again. Interesting. And confirmed cash flow from operations guidance range of $12.5 billion to $13.5 billion. Interesting. So we got the quote from the CEO. Quote, "We delivered another strong quarter while executing on the strategy we outlined in December 2021. Leading it to the... Wait. I have this right. Yeah, May 3rd. That was weird. Why is she talking about... Okay.
Maybe the strategy they outlined during that time?
I guess. While executing on the strategy we outlined in December 2021. Sorry. Leading to the close of the Signify Health acquisition, followed quickly by Oak Street Health. These additions are core to our strategy and will help unlock future growth as we push further into value-based care, which prioritizes keeping people healthy." Pretty short, pretty sweet. I mean, it is what it is. There really isn't anything much to say when it comes to that. I want to know if there's anything, though, in regards to share buyback, because let me see over here. So if I put repurchase, let's see. There's actually, right here. So returned $779 million to shareholders through dividends and repurchased 22.8 million shares of common stock. That's interesting to see, because when we take a look at the stock, the shares outstanding, it's actually not looking too high. It could be worse though, but it's interesting. They did buy back. Is there anything else? No, I believe that's it. All right. So you can see here that they are giving out a dividend and they're also buying back shares. Really, really good overall. Now, if you guys were watching the live stream earlier, you probably saw me going into this because, we're going to take a look at CVS, guys. We got the ticker for CVS, market cap of $89.7 billion, a P of 22.35 with a current share price of $70.08. If we take a look at this graph, CVS is down. This is CVS, yes. CVS is down 27% on the 1 year. Year to date, they're also down 24.6%. Looking at this range, we are at 52-week lows when it comes to this company. That's crazy. $69.32 for the low and $107.26 for the high. Very, very interesting to say the least. This might be a company that we might consider actually, well, depending on what we see with the fundamentals, this might be a pretty good one, guys. By the way, Mike, we got 20 people watching on Rumble.
Wow.
And eight people watching on YouTube.
Wow. Thank you for all the views on Rumble and YouTube, guys.
Thank you all so much. Like, oh my god. And if you guys, the best way that you guys can help us, like, subscribe, and comment. That's literally it. We appreciate if you guys, give a little bit here and there as like a tip. We appreciate that. But at the end of the day, like, subscribe, comment. That's really it.
Your comments are actually worth more to us because we like interacting with our viewers.
Yes,
absolutely. To us, it's more interesting because we get to bounce ideas off of you.
Absolutely. So going back to this, guys, this is a 52-week low company. So let's come back into this. And we do see that they do pay the dividend of $2.42. And looking at this dividend is 3.33%, rather high, not bad. Payout ratio of 25.11%, a 5-year CAGR of almost 3%, so not that high, with 1 consecutive year of dividend payment. That kind of worries me. Why is it 1 year? And wow, okay, so the reason why it's 1 year is because looking at the dividend history, they kept it the same. They never cut it, but they did keep it the same from 2017 all the way up to 2022. So it's consistent. I'll give them that. It's consistent. I would be a lot more worried if they cut it for like no reason. Like if it was they cut it because of COVID, then okay, fine, COVID. But the fact it's almost like a Citigroup. They kept it consistent. It's something that you can 100% guarantee. Okay, well not 100%.
Kind of like it's like kind of their known thing, right?
Right.
Certain companies just choose that this is how we're going to operate. So.
Yep. We're not going to increase dividend, but at the same time, it's pretty constant form of income. Ex-dividend date passed as of... Say it!
No, 420.
420! Payout date was 2 days ago on May 1st, and they pay their dividends quarterly. So let's come back into this, and we can see that based on the current shares outstanding, they pay out, guys, $3.15 billion. And in regards to the 5-year average free cash flow, after this is paid, they're still left with $8.8 billion, and as of their last year's free cash flow is 10.3. Something that we want to see is that we want to see their last year's being higher than the average, so that's really, really good. And in regards to the payout ratios for these free cash flows, it's 23.4 for the last year's free cash flow and 26.29. So it's looking really good. Not only can they pay out this dividend, but they can increase it if they so wish to do so. All right, so let's move it now into the fundamentals. We got the net income 5 years ago of negative $594 million to 1 year ago of $4.15 billion, increase of 798%. So what do you think about this graph? By the way, I want to have Mike now give me the percentages for what he thinks he would give the graph from a scale of 1 to 100%.
50 or 45, just because I don't like the jump up and jump right back down. It kind of it brings into question, are you a statistical anomaly on those 3 years, especially because it's COVID.
Well, also understand that they may have done like an acquisition also. They did say that they did do an acquisition, so that may have something to do with it. But all right, 50%. We got now the free cash flow. We got 5 years ago of let's just say $7 billion to 1 year ago of $13.45 billion, increase of 97% with an average of almost $12 billion. What do you think about this graph? How's it looking? It's looking actually pretty good, right? From 5 to 2.
85, 80, just because you have some not meeting the trend, but then again, you are increasing overall.
Right. Okay, so we got now the revenue. We got 5 years ago of $194 billion to 1 year ago of $321.63 billion, increase of 65.86%.
It's almost 100 for me, just because the 5 years are going to drop right off. So,
all right. Looking now at the assets minus the liabilities. Well, we can see that at least they've been very, very consistently in the positive. That's pretty good. Though as of 2 years ago to 1 year ago, it's come down a little bit by around $4 billion or so, but not too bad. Average total assets.
Could be that acquisition point.
It may have been. So we got average total assets. It is $228.5 billion. Average liabilities is 158.1. Why am I drawing a blank? $0.17 billion. Doing this difference, we get $70.4 billion. Grade?
95.
95?
Oh, sorry. 85. My bad.
85. All right, 85. All right, now let's take a look at the cash flow minus the liabilities. Pretty consistent. What did you think?
I don't like decreasing trend. I don't like how it's holding that.
It is decreasing trend, but it's not look, their lowest
It's
point
like a
was
sine graph.
their
It's like a
lowest-
sine
it's like a
graph,
sine
down,
graph.
up, down, up, down.
Look, their lowest point was, yeah, 4 years ago. And as of today, they're only a little bit lower than the average, which is negative $142.4 billion. So
65, 70.
60, I'm gonna go with 65. Yeah, I'm gonna go with the 65. Okay, and now for the one that actually caught me by surprise a little bit. Got the shares outstanding. You can see here that it is slightly increasing on the 5-year, but massive decrease in 1 year. Yeah, we got 5 years ago of 1.295 billion shares to today of 1.3 billion shares. That is an increase of, well, less than 0.4, to be exact, 0.39. But from the previous year to the current year, look at this. That is a decrease of 1.66%, going from 1.322 billion to 1.3 billion. So what would you give this as a grade?
I almost want to say like a 85 for one reason. You issued shares because you needed to raise capital, and now you're buying it back. So it's almost like we promised you we were going to buy it back type thing later. I use it. This is almost like you issue shares and it's soundly invested, and then now it's returning to the investor.
I agree. And again, we just read in the earnings report, repurchased 22.8 million shares. So that's happening like right now. And lastly, when it comes to the cash equivalents, they currently hold almost $13 billion with an average of $8.8 billion. Looking at the overall grades, guys, we gave the net income of 50%. It started off rather bleak, honestly. Free cash flow, 85%, revenue, 100%, assets minus liabilities, 85%, cash flow minus liabilities, 65%, shares outstanding of 85%, overall grade of 79. This is not looking too bad. The main problem, I would say, is the net income. But it's not even looking that bad. It's mainly just the spikes, right?
Yep.
Yeah. So 79%, it's not looking too bad, guys. Almost 80%. You could make the case for anything here to be a little bit higher. You would essentially be put over the 80% mark after that point. But here's the thing. What do we pay for this company? Okay. And this is why I'm always hoping for red days. Why I'm always hoping for a crash. Because I want to buy companies like these at great valuations. Is $70 a great valuation? I don't know. It's near 52-week lows, but at the end of the day, every investment is the present value of all future cash flow. If I'm going to give you $1 every single year for the rest of your life, how much are you willing to pay for that dollar every single year for the rest of your life? That's essentially what that means. So let's take a look at this. We got only the required rate of return. These numbers are already massive. $139 for the lowest assumption, all the way up to, $139 for the lowest for the assumption, not adjusting for debt. My bad. And then adjusting for debt, we got $106.56. So, Mike, here is Seeking Alpha's growth tab, and they're expected to grow at almost 4%. Looking at the revenue over here, we don't have the percent, but you can see that the revenue grew around 8.4 billion. So 4%, what would you give this? Yeah, give me some assumptions.
So basically 0% for low. I don't think they're going to have negative. 4% for median.
Okay.
And we'll run a stretch goal to 8.
Okay. I think that's pretty fair. And then the projected share buyback.
So they bought back 1.6%.
No, yes, 1.6 in the last
year.
Yep.
So let's just, this is the 5-year expectation, right? So if they continue buying 1.6% for 5 years, you would get to about, doing the math, 9% roughly. So let's do, would it be?
No.
What am I talking
It'll
about?
be 5. It'll be 5%.
Yeah.
It'll be like 6%.
Or 5 points. Yeah. So let's do 357 buyback.
3 buyback, 3, 5, and 7%. Honestly, I pretty much would have given this something similar as well. Maybe not 0, but yeah, I would have given this something similar. So with these assumptions, guys, we get $143.17 all the way up to $197 for the low to medium high assumption, not adjusting for debt. Adjusting for debt, $109.82 to $162.28. With the margin of safety of 5, 10, and 15, we get $93.35 to $154.17. I mean, $70.08. This is looking like a pretty good buy right now. Obviously, not financial advice. Now, I'm going to address the elephant in the room here. what is the biggest, what is the highest peak that they've been in? So it's around like $108 at their peak they've ever done. So a lot of you may be like, yeah, but it's never gotten as high as 143 or whatever. The thing is that this calculator doesn't tell you what the stock price is going to. It tells you the intrinsic value of a company. That's all that's telling you, right? The stock price tomorrow could fall. In fact, I didn't even show this. Intraday, it has fallen 3.68%, right? But at the end of the day, this number doesn't mean anything, right? It's the intrinsic value of the company that matters. And eventually, stock prices, share prices follow the company's fundamentals. If the fundamentals are good, it'll eventually follow it. Whether that be tomorrow or 5 years down the line, 10, 20, etc. At the end of the day, they will come back to normal. So that's why I'm looking at this. I'm like, yeah, I mean, with an 80% grade, this isn't looking too bad in my personal opinion. What do you think?
I think it's pretty good. There's some cautionary signs on the technicals.
Okay, well, we'll get to that in just 1 second. Let's take a look at this dividend, though, because I'm pretty sure a lot of people want to buy this company for its dividend, which I don't suggest us buying a company solely for its dividend, but, it's still a nice, it's a little bit of icing on the cake. Putting in $5,725, guys, this nets you almost $200 in annual dividends. Not too bad, but you're really not expecting a lot of growth when it comes to this dividend. It's a dividend that maybe once in a blue moon you'll get a little bit of an increase, but it'll most likely just be consistent. But again, current price $70 is looking fairly good when it comes to the discounted free cash flow. Again, please do not follow what I'm saying. This is not gospel. Every investment is the present value of all future cash flow. All of these calculators, guys, are for free. They're in the link in the description below. Have them, make your own assumptions, give them your own grades, and see where you land, okay? Because this is not financial advice. So let's move now into the technicals, shall we? And let's see what they have to say.
If we look at CVS, we're actually going to look on the SMAs first. And I'm going to make this pretty simple. I talk about this in most of the analysis. If you're below the 200 weekly, it's pretty much bullish, or sorry, correction, bearish. And you do have an A to B pattern on the way down. So if we draw this A to B pattern, that basically they're confirming completion, it gets you down to the $59.90 level. Now, please remember that value. It's going to be important in just a second. So if CVS is going to continue its downfall, and a lot of this chart is reminiscent of companies that basically stay below their 200 weekly moving average for a long time before they recover. The things I don't like is the company falling this far from all-time highs, which is about 36% down. Not terrible, but it is something that we have to be cautious about. You could spend several years under this 200 weekly moving average, not really gaining much growth. However, it is a dividend company, so you could use different strategies, selling covered calls if you have over 100 shares on the stock per contract, or various different things that you could leverage in order to basically not lose a lot of equity in this and gain as you go along with the dividend. Now, if I go to the weekly, this is where I always tell you guys, go to the weekly, look at the big time frames. It tells you a lot with the chart. You're pounding right on the reversal zone and a price action zone, and you have a price targeting here. Now, what does that mean? You could go lower. Just basing off of this, you could possibly go lower. Your first support, I'm going to say, is $65.66. And we talked about $59. You in this area of $53.43 is basically going back to the COVID lows, or around where we had consolidation of the COVID lows. On top of, we have a double peak action back in 2019 and then 2020 around the $69 price point. So that's where you are now. So maybe you are going to find a bottom in the near term future. However, if you crack that, the two areas I'd be looking at is $65.66 and possibly even a runner target down to $53.58. So with that, if we look at the daily and then give you a little bit more information on that, you are forming what is called a MACD divergence, where price is going down, MACD is making higher lows. So this is going to break eventually. But again, I use this as an example. There's been a MACD divergence on natural gas, and all natural gas does is burn a hole in someone's pocket and keep going lower. So don't necessarily play the stock just because it has a divergence. RSI is looking like it wants to come back down into this oversold territory. So I do think you still have another leg down before it gets to an evaluation that I think would be promising. Volume is starting to ramp on the daily, especially on the weekly. You haven't really had a big volume spike, so you are decreasing volume, but price is going down, so maybe you're going to have a reversal soon. But for me, if the RSI gets to oversold on the weekly and the MACD finally forms a second bottom here, that's where I'd be looking to buy in on the weekly. Probably, like I said, targeting that $65.76 area. I think that'll be an extremely interesting buying point, because it's going to be severely oversold on the weekly, and the daily would just basically get pummeled into the ground. This divergence would probably continue onwards or possibly even break to the downside, but then you can reassess how it's doing. But overall, just looking at it, I don't think the time is now to buy the company. I think it has a little more price action to sort itself out. And then I think once you'll see the consolidation, usually companies, when they stop falling down, they or sideways consolidation. When you see evidence of that, you have very defined risk to reward. That's basically going to define if you're going to go up or you're going to go down. And it's as simple as I can make it. If you have consolidation, then you basically put a stop loss right below. You get stopped out for like 1%, and it's not a big deal, versus riding it all the way down 30-40%. But again, do your due diligence, make sure you have proper risk management. Just don't buy a company, like we said, just because it has a dividend, and don't buy a company just because it had a down day. Make sure you have a plan and a actionable plan to execute for the trade. But again, this company, I think, is soon to come into an evaluation that's going to be very appetizing on the technical side, and I think it's already appetizing on the fundamental side. But I do think there needs to be a little more trimming on the company before personally I would get it.
By the way, yeah, what's up? I thought you were.
And that's all I got.
Oh, okay, great. By the way, I absolutely love the fact that you and I have completely different opinions of like what prices is a good price to buy that. It's actually really, really good, right? Because you're looking at it from a technical perspective. I'm looking at it from a fundamental perspective. And that's actually really, really good that we have such different, views. I mean, you think that a better price to buy out would be a much lower. At least that's what the technical is saying. Yet with me, it's saying that right now it's a pretty decent price, right? So I like that. Honestly, I really do like that. But guys, I think we're going to be wrapping this up right now. And tomorrow we're going to have another live stream. If right, Mike, we're going to have another live stream.
We're going to try. No promises, just because, life may throw a couple curveballs out there, but we're going to definitely try for you guys.
Please, because tomorrow we got Apple, Shopify, Block, Moderna, and a company that is not here, which we're going to try to do. And I really would like to do it. You know what I'm talking about?
Yes, I do.
Okay. Guys, we're going to try and cover...
Yeah, save it as a special. Save it as a surprise for them. You guys got to tune in tomorrow to see which company is going to be a surprise.
Oh boy. Okay, fine. I'll leave it as a surprise. You'll see it tomorrow on the title of the live stream. But yeah, we're going to definitely cover Apple. We're going to cover Shopify or Block, and then maybe one more, which is not here. And that one is it's going to be an interesting one to say the least. But anyways, guys, I think that will pretty much do it for this live stream. Thank you so much, guys. And of course, for the video, if you guys are watching the video at 4 o'clock, thank you so much for watching. We really, really do appreciate it. And that will pretty much do it, guys. If you like, comment, subscribe. It really does help with the algorithm on YouTube. Y'all can follow us on the New Tech Sites. Link is in the description below. Shout out to everybody who showed up on YouTube. Shout out to, at one point we got 20 people on Rumble. And we got one last comment here on Rumble. There's always a chance the U.S. does not raise debt ceiling and defaults and make all the... Yeah, I don't know about that one.
Hey, we'll save that for tomorrow's
video. We'll save that one for another day. We'll save that for another day. But yeah, guys, thank you all so much. Again, the best way you guys to help us is like, subscribe, comment. Thank you so much. We really do appreciate it. And peace out.